Stocks whipsaw as investors grow more concerned over U.S.-China trade tensions. Trump hitting Beijing with a 145% tariff on imports this week, and Xi Jinping retaliating with a 125% tariff on all U.S. goods. Here to talk about it is Chief Investment Officer at Morgan Stanley Wealth Management, Lisa Shalett. Lisa, is the tariff showdown just a matter of riding out some short-term unpleasantness for long-term rewards, or is it more complicated than that?
Our perspective is it's a lot more complicated than that. If you think about it in the very short term, we fundamentally believe that a trade war broadly fought around the world with 10% universal tariffs and the reciprocal tariffs and escalating tariffs on China basically reduce economic growth for the year to something that we had been estimating at just under 2% to something just under 1%. In addition to slower growth, it's also likely that just these tariffs as they exist today are probably going to add 1 full percentage point by our estimates to the inflation rate. So if you think about the inflation rate today being somewhere around 2.8, 3%, we're talking about by midsummer an inflation rate of about 4%. So slower growth, higher inflation, that suggests to us for the next 2 quarters what we would call a stagflationary environment, which is very hard on both consumers and businesses.
Do you think the stock market is pricing that in? Shares are cheaper in the U.S. than they started the year. Should investors be buying here or should they hold off?
Our advice has been to hold off. And the reason is while the price level of stocks is lower, that's for sure, it's 9% lower, profits are also going to be lower. And that's our point in talking about lower GDP growth. Most analysts have not yet fully cut their profit forecasts for the year, and we think that that's what's coming. So if prices are down 10% and profits are down 10%, your valuation hasn't improved at all.
I think the consensus is double-digit earnings growth for the year. You don't find that realistic?
Absolutely not.
Is it flat growth? Is it an earnings reduction? What do you think?
Our best guess is that maybe earnings grow, 3-4% year over year, but nowhere near the 12%, 13% that was penciled in January.
Okay, there was a big sell-off in bonds that rattled investors, but yields are up. Do you find bonds attractive here? And tell me also, in addition to bonds, what are the areas that investors should be looking at if they're looking to offset some of their stock risk right now?
Sure. I mean, let's start with what's going on in bonds, because I think the bond market is telling a very interesting story, and it's a very important story because while there are risks that economic growth is slowing and that inflation is moving up, the fact that the bond markets are not discounting a recession, the fact that the bond markets have backed up in terms of yields this much, we fundamentally believe reflects this understanding that the bond market now has that almost under any scenario of a tax bill that we get from this House and this Senate is going to add to the total deficit and add to the total debt over the next 10 years. And that means a higher cost of capital. So we're not buying long bonds here. For our clients who are taxable clients, we are saying, maybe you should be buying intermediate municipals, but we're continuing to stay short duration in bonds.
Any other safe havens?
Yeah, the short duration bonds should be the safe havens. Where we do think that investors should continue, to build positions in what we call real assets. Real assets are exactly what they sound like. They are real estate. They are infrastructure. They're things like commodities, things like gold, things like residential housing, things like master limited partnerships in energy. These type of assets tend to hold their value very, very well during periods of economic slowing as well as inflation.
Thank you, Lisa Shalett.